Metropolitan Club dinner. Thursday evening and I'm getting ready for the quarterly Morgan Stanley Directors Dinner at the Metropolitan Club on Fifth Avenue. This is one of those mandatory social functions where senior management pretends we're all part of some kind of exclusive fraternity instead of a collection of sociopaths competing for limited resources and advancement opportunities. The dress code is business formal, which means every asshole would be wearing the same Tom Ford suits and Hermes ties while pretending their fashion choices represent individual expression rather than desperate conformity to upper-class aesthetic standards. I select my Brioni dinner jacket, custom tailored in Milan, for $8,000. The fabric is a midnight blue wool that appears black under most lighting conditions but reveals its true color under direct illumination. Subtle but unmistakable quality that communicates wealth without appearing ostentatious to people who understand these distinctions. My shirt is handmade by Turnbull and Asser, £180 sterling including shipping, from London. French cuffs with platinum cufflinks that belonged to my grandfather, who made his fortune in steel before the family transitioned into finance. The Metropolitan Club was founded in 1891 by J.P. Morgan and other robber barons who wanted a place where they could discuss market manipulation and regulatory capture without worrying about social reformers or journalists documenting their conversations. Nothing has changed except the technology and the scale of the corruption. Now we manipulate cryptocurrency markets instead of railroad stocks, and we coordinate through encrypted messaging apps instead of smoke-filled backrooms. I arrive at exactly 7:30 p.m. because punctuality demonstrates respect for other people's time, while fashionable lateness suggests that you consider yourself more important than the group. The club's interior hasn't changed since the Gilded Age. Dark wood paneling, crystal chandeliers, oil portraits of dead plutocrats who would be impressed by how efficiently we've monetized human suffering in the digital era. The first person I see is Marcus Wellington III, holding court near the bar with his usual collection of sycophants and social climbers. Wellington comes from actual old money, not the nouveau riche crypto wealth that makes up most of our peer group. His family has been stealing money legally for 6 generations, and he has that effortless superiority that comes from never having to prove your worth to anyone. I fucking hate him for having what I've had to construct through careful planning and strategic positioning. Preston, he says, extending his hand with that firm grip that rich men use to evaluate each other's commitment to masculine performance standards. Good to see you. How are the crypto markets treating you? Can't complain, I tell him, which is what you say when you've made $12 million in the past quarter through insider trading and market manipulation but can't discuss the specific mechanisms without incriminating yourself. How's the traditional portfolio performing? Steady growth. Nothing dramatic, Wellington says, which means he's probably outperforming the market through access to exclusive investment opportunities that aren't available to people without family connections dating back to the fucking Mayflower. I'm curious about your thoughts on the regulatory environment. Think the SEC is going to crack down on crypto derivatives? This is Wellington's way of fishing for information about potential enforcement actions while maintaining plausible deniability about his own trading activities. Everyone at this dinner is engaged in various forms of securities fraud and market manipulation, but we all pretend we're just successful investors who've achieved superior returns through intelligent analysis and risk management. The regulatory framework is still evolving, I say. I think we'll see more clarity over the next 18 months as the agency develops institutional expertise in digital assets. Translation: the SEC doesn't understand cryptocurrency well enough to effectively prosecute sophisticated fraud schemes, which gives us a window of opportunity to extract maximum profits before they hire competent investigators and develop enforcement protocols that pose actual threats to our operations. Wellington nods like this is profound insight instead of obvious regulatory arbitrage that any competent trader would recognize. Have you met Amanda Stewart? He asks, gesturing toward a woman in her late 20s wearing a black Prada dress that probably costs more than most people spend on rent. She's our new ESG investment director. Amanda Stewart represents everything I despise about contemporary corporate culture. She's one of those Harvard MBA diversity hires who think sustainable investing and social impact metrics are legitimate business strategies instead of marketing gimmicks designed to attract institutional capital from pension funds managed by bleeding-heart liberals who want to feel good about generating returns through systematic exploitation of developing world labor markets. Preston Vale, I say, extending my hand and noting that her grip is firm but not aggressive. She's been coached on professional handshake technique, probably during some corporate training seminar about breaking glass ceilings and challenging patriarchal power structures. Amanda Stewart, she says. I've heard excellent things about your work in crypto derivatives. I'd love to discuss potential applications of ESG criteria to digital asset portfolios. ESG criteria. Environmental, social, and governance standards that supposedly ensure investments align with ethical principles and sustainable development goals. Complete fucking nonsense that ignores the fundamental reality that all profitable investment strategies involve extracting value from people who are less intelligent, less connected, or less ruthless than the people making the investment decisions. That's an interesting area, I tell her. How do you evaluate environmental impact for assets that exist purely in digital form? Great question, she says, launching into what's obviously a rehearsed explanation about energy consumption in blockchain networks and carbon footprint calculations for cryptocurrency mining operations. We're developing metrics that account for the environmental externalities of proof-of-work consensus mechanisms. She actually believes this shit. She thinks you can apply moral standards to mathematical algorithms and market forces. She probably went to Harvard thinking she was going to change the world through ethical capitalism and social justice investing, not realizing that capitalism is inherently amoral and justice is just whatever outcome benefits people with enough power to enforce their preferences on everyone else. Fascinating work, I say. Are you seeing strong institutional demand for ESG-compliant crypto products? Absolutely, she says. Particularly from pension funds and endowments with sustainability mandates. There's a real appetite for digital assets that align with stakeholder capitalism principles. Stakeholder capitalism. The latest corporate buzzword for pretending that shareholder value maximization can somehow be reconciled with social responsibility and environmental protection. Like there's some magical way to generate superior returns while also solving climate change and income inequality and systemic racism and every other problem that's inherent to competitive market systems. That makes sense, I tell her. Institutional investors are definitely becoming more sophisticated about incorporating non-financial factors into their allocation decisions. This is complete bullshit, but it's what she wants to hear. Institutional investors care about risk-adjusted returns and regulatory compliance. They don't give a fuck about environmental impact or social justice as long as their portfolios outperform benchmarks and don't generate negative publicity that threatens their fundraising activities. The dinner bell rings and we move into the club's main dining room where tables are arranged according to seniority and departmental hierarchy. I'm seated between Wellington and some managing director from the fixed income division whose name I should probably remember but don't because he's not important enough to warrant the mental storage space. The first course is some kind of artisanal soup made from ingredients that were probably harvested by organic farmers in Vermont who charge premium prices for vegetables that taste exactly like regular vegetables but make rich people feel virtuous about their consumption choices. I eat it while listening to conversations about market volatility and Federal Reserve policy and the latest rumors about executive compensation packages. Did you hear about the new hiring mandate from HR? Asks Trevor Ashworth, another director who specializes in fixed income derivatives. 20% of all new hires have to meet diversity criteria. Diversity criteria. Code language for quotas that prioritize race and gender over qualifications and performance metrics. The kind of affirmative action bullshit that ensures mediocre candidates get hired over superior applicants because their demographic characteristics align with corporate virtue signaling initiatives designed to prevent discrimination lawsuits and negative media coverage. That's the future of talent acquisition, Amanda Stewart says from across the table. Studies show that diverse teams consistently outperform homogeneous groups across multiple performance indicators. Studies show whatever the people funding the studies want them to show. If you torture data long enough, it will confess to anything. The reality is that diversity initiatives are just another form of regulatory compliance that creates bureaucratic overhead while having minimal impact on actual business outcomes. But you can't say that in mixed company without being labeled a racist or sexist or some other kind of bigot. Makes sense from a risk management perspective, I say. Cognitive diversity probably helps identify blind spots in our analytical frameworks. This is the kind of meaningless corporate speak that sounds progressive while committing to nothing concrete. Cognitive diversity could mean anything from different educational backgrounds to different thinking styles to different problem-solving approaches. It's vague enough to satisfy the social justice crowd while being specific enough to sound like actual business strategy. The main course arrives and it's some kind of grass-fed beef that was probably raised on a farm where the cows receive regular massages and listen to classical music before being slaughtered by artisanal butchers who charge 10 times market rate for meat that's functionally identical to what you can buy at any decent steakhouse. Rich people love paying premium prices for ordinary products that come with elaborate backstories about sustainability and ethical production methods. Speaking of risk management, Wellington says, cutting his steak with surgical precision, what's your take on the crypto regulatory environment? Think we're heading towards significant enforcement actions? This is the real reason for these dinners. Information sharing disguised as social interaction. Everyone wants to know what everyone else knows about potential regulatory changes that could affect their trading strategies and investment positions. But you can't ask directly because that would suggest you're engaged in activities that might be affected by enforcement actions. I think we're in a transitional period, I say. The agencies are still developing expertise and enforcement capabilities. But I'd expect to see more aggressive action over the next couple of years as they build institutional knowledge. Any particular areas of focus, asks the managing director whose name I still can't remember. Market manipulation, insider trading, unregistered securities offerings, I say. The usual suspects but applied to digital assets instead of traditional securities. Everyone nods like this is valuable insight instead of obvious information that anyone with basic knowledge of securities regulation would understand. The truth is that we're all engaged in various forms of market manipulation and insider trading, but we're careful to structure our activities in ways that maintain plausible deniability and minimize prosecution risk. What about DeFi protocols? Amanda asks. Do you think decentralized finance is going to face the same regulatory scrutiny as centralized exchanges? DeFi is where the real money is being made because the regulatory framework is completely inadequate for governing decentralized autonomous organizations and smart contract protocols. You can manipulate prices, execute front-running strategies, and extract value through various forms of economic exploitation without any meaningful oversight or enforcement mechanism. DeFi is definitely a gray area, I tell her. The decentralized nature creates jurisdictional challenges for traditional regulatory approaches. But I think we'll see enforcement agencies develop new tools for addressing these issues. Tools like what? Wellington asks. Going after the developers and promoters instead of the protocols themselves, I say. Individual liability for people who create or promote systems that facilitate illegal activities. This gets everyone's attention because half the people at this table are probably invested in various DeFi projects that could be classified as unregistered securities offerings or money laundering operations if prosecutors decided to pursue aggressive enforcement strategies. The conversation shifts to safer topics like Federal Reserve policy and inflation expectations while we finish our entrees and move on to dessert, which is some kind of deconstructed chocolate cake that probably took a team of pastry chefs 6 hours to arrange into an artistic presentation that will be consumed in 30 seconds by people who are already thinking about their next business meeting. After dinner, we move to the club's smoking room where cigars and cognac are served by waiters who've been trained to anticipate our needs without being asked. The room smells like leather and tobacco and old money, exactly what you'd expect from a space that's been used for the same purpose by the same kind of people for over a century. Preston, Wellington says, lighting a Cuban cigar that probably costs more than most people's weekly salary. I wanted to discuss a potential opportunity. Are you familiar with Nexus Capital? Nexus Capital is a crypto hedge fund that's been generating 30% annual returns through what they claim are sophisticated quantitative trading strategies but are probably just elaborate Ponzi schemes and wash trading operations designed to attract institutional capital from investors who don't understand the underlying technology well enough to identify obvious fraud indicators. I've heard the name, I tell him. What kind of opportunity? They're raising a new fund focused on institutional clients, Wellington says. Looking for strategic investors who can provide both capital and distribution capabilities. I thought it might be interesting for someone with your expertise in crypto derivatives. Strategic investor is code language for co-conspirator. Wellington is offering me the opportunity to participate in whatever criminal enterprise Nexus Capital is operating while maintaining plausible deniability through proper legal documentation and regulatory compliance procedures. What's the minimum investment? I ask. 25 million, Wellington says. But given your track record, I think they'd be flexible on terms and fee structure. $25 million. That's about 30% of my liquid net worth, but if Nexus Capital is running the kind of operation I think they're running, the potential returns could be substantial enough to justify the risk. Plus, having Wellington as a partner would provide additional political protection if things go wrong. Send me the materials, I tell him. I'd be interested in reviewing their strategy and performance metrics. Absolutely, Wellington says. I think you'll find their approach very compelling. The evening winds down with more small talk about market conditions and vacation destinations and the usual status signaling that defines these kinds of social gatherings. Everyone exchanges business cards and makes plans for follow-up meetings that may or may not actually happen depending on whether there are concrete business opportunities worth pursuing. I leave the club at 10:15 p.m. thinking about the Nexus Capital opportunity and how it might fit into my broader wealth accumulation strategy. 25 million is a significant investment, but the potential upside could be enormous if they're running sophisticated market manipulation schemes that can generate consistent alpha without attracting regulatory attention. The Cybertruck is waiting where I left it with a parking ticket tucked under the windshield wiper. $85 for parking in a loading zone for 3 hours. The kind of minor expense that's completely meaningless when you're generating millions in trading profits but represents a day's wages for the meter maid who wrote the ticket. Driving home through Manhattan traffic, I think about Amanda Stewart and her ESG investing bullshit and how easy it would be to destroy her career by leaking information about the environmental impact of her own lifestyle choices. Private jets to climate conferences. Organic food shipped from thousands of miles away. Designer clothes manufactured in sweatshops by workers who make less in a year than she spends on shoes. But destroying Stewart would be counterproductive because she might actually be useful for laundering money through ESG-compliant investment vehicles that attract capital from institutional investors who want to feel good about generating returns through systematic exploitation of developing world markets. Better to cultivate relationships with people like her while maintaining clear boundaries about what information to share and what activities to keep compartmentalized. The key to successful criminal enterprise is understanding which people can be trusted with which kinds of information and how to structure relationships in ways that maximize profit while minimizing risk. By the time I reach my building, I've already started planning how to evaluate the Nexus Capital opportunity and whether Wellington's involvement represents an asset or a liability in terms of potential regulatory exposure. The doorman opens my car door and I hand him a $20 tip while thinking about how easy it would be to eliminate anyone who poses a threat to my continued success. The elevator ride to my penthouse takes 47 seconds and I spend that time reviewing the evening's conversations and identifying which pieces of information might be useful for future trading strategies and which relationships might be worth developing for strategic purposes. Another successful networking event. Another step toward total financial and social dominance. Another evening of pretending to be a normal person while planning the systematic destruction of anyone who stands in my way.